Hello, and welcome to Deloitte's Debriefs Tax Webcast series in Asia Pacific. Our webcast today is from our corporate income tax series and is titled Australia Tax Updates. My name is Manusri Skantaraja, and I'm an international tax partner based here in Deloitte, Australia. And I have the pleasure of hosting today's webcast. Joining me today, I have another speaker with me, Amelia Teng. Amelia is also an international tax partner based here in Deloitte, Australia. You may access our bios on the left-hand side of the screen. Before I introduce the agenda for today's webcast, I'd like to take a moment to highlight some of the features on our webcast console. Firstly, all users are on listen-only mode. If you have any content-related questions, you can submit at any time in the Q&A box at the bottom right-hand side of the screen. We'll do our best to respond to your questions during the presentation. Secondly, all PC users can maximize or minimize each box at your convenience during the webcast. You may also explore the icons at the bottom of the screen. If you want to download today's slides and related publications, please go to the downloads and link box below. On the other hand, mobile device users can view the slides and answer the survey on screen. Thirdly, if you require an attendance record for this event, you will receive an automated email with CPE certification after watching for 50 minutes. Hopefully you're still with us by then. Now we can move on to the agenda. So today's agenda is essentially also the agenda the Australian government has in train to reform Australia's international tax laws. There's a number of proposals in place, and they're really centered around three broad categories. One around interest limitations and debt around the debt rules, a set of measures proposed around intangibles, and a third set of measures around transparency. Now, all of these measures are still currently proposed. We still don't have passed laws yet. But notwithstanding, the government is committing to have these laws implemented and in place along that timeline you see there. So notwithstanding that we passed 1 July 2023, the government is committed to have these rules go live from that effective date, particularly in relation to the new interest limitation rules and the first phase of transparency measures. In terms of the intangible measures, they are also expected to apply for payments currently made. So payments on or after 1 July 2023 this year. The government's also announced that it's committed to the Pillar 2 regime to commence from 1 January 2024, and also a second stage of transparency measures, the public CBC reporting, to commence from 1 July 2024. So that sets the stage for our agenda today. As mentioned, these are all proposals. The interest limitation rules and the first phase of the transparency measures are currently before Parliament in bill form and passing through. They are being put to a Senate committee, so we do expect some amendments coming out of that. The Senate is due to report on their findings at the end of this month. The intangibles measures are in a revised exposure draft form, so we do not have a bill on that as yet. We don't have any draft legislation as yet on Australia's Pillar 2 implementation. And we have some draft legislation on the public CBC reporting, but that is still subject to further consultation. So with that background, I might start discussing the new interest limitation rules. Next slide, please. So many of you may be familiar with Australia's rules prior to 1 July this year, which were essentially three sets of measures: a safe harbour debt test, which was a balance sheet-based measure; a worldwide gearing test, which is also a balance sheet-based test, but having regard to the capitalisation of the global group; and an arm's length debt test, which is a hypothetical amount of debt that a group can sustain, having regard to what a willing borrower would borrow and a willing lender would lend. Those three regimes are going to be repealed insofar as they apply to general investors, Some of those regimes are still applicable for financial entities and ADIs, but for purposes of today, we're going to be focusing on general class investors. Now, what we typically knew as the safe harbour debt test, which has a balance sheet based test, is going to be replaced by a fixed ratio test. And most of you will be familiar with such a test, so it's quite common around the world and is based on the OECD proposals under the BEPS actions. Broadly, the test limits debt deductions in Australia to 30% of the entity's tax EBITDA. And that is the default test for taxpayers who are within the scope of the rules. There are two alternative tests. The group ratio test, which in summary essentially sets what that allowable ratio is if it's greater than 30%, having regard to the group's EBITDA compared to their interest deductions. And the final test, and this is essentially can be thought of as the replacement to the arm's length debt test, is a third-party debt test, which is the actual amount of debt or interest deductions from external debt that meet a whole range of conditions. And we'll go through that in a bit of detail. Now, finally, as part of these rules, in the bill, there is also a couple of measures called debt creation rules. So these sit separately to the interest limitation rules, where under certain arrangements where debt is introduced into the Australian system, deductions could be denied if they were used for certain purposes. And we'll go through that as well. Now, one critical element as part of these new measures is that it gives some additional impetus for our transfer pricing rules. Now, traditionally under our current thin capitalisation rules, to the extent an amount of debt is allowable within our safe harbour requirements, for example, that amount of debt is respected broadly from a transfer pricing perspective, and that amount of debt is the debt that's to be priced, essentially. Now, that is now being repealed as part of these measures, and so it now restores transfer pricing's ability, or our transfer pricing rules' ability, to also inform what an appropriate amount of debt should be in the Australian system. So that is quite a profound shift in terms of thinking about the appropriate structure and capital structure in Australia. Not only the amount of debt deductions allowable, but how that operates in the context of our transfer pricing rules. Might go into a little bit more detail on the next slide, please. Okay. Now, for those who've been following these measures, I might just briefly touch on the evolution before we got to the bill stage. There was an exposure draft that was produced by the Treasury earlier this year, going through a series of public consultation. Some of those have been incorporated, some of those have not. And what we have are some further refinements. Some are beneficial, some are actually quite detrimental in some senses. A key change to the initial exposure draft is that in terms of those alternative tests, the group ratio test and the third-party debt test, the choice to use those tests are now potentially revocable if the Commission is satisfied that it's fair and reasonable to do so. Under the previous draft, that was an irrevocable choice. Now, there has been certain updates to how the fixed ratio tests worked. Most significantly, dividends and distributions received from associate entities can no longer be counted as part of your tax EBITDA. What it does is it eliminates that economic double counting of earnings. And that can have some quite profound impacts, which we'll explain in examples later today, if the debt is in the wrong position in a group. There has been some additional concessions around what additional capital allowances can be added back. And however, there's no longer an ability to add back prior year revenue losses. So that has some additional implications in how the calculation works. A welcome change to what was in the exposure draft stage is that the ability to carry forward denied deductions to future income years. Previously, there were quite onerous restrictions around those, particularly around ownership tests. But now corporate groups can also rely on a business continuity test, even if there is a change in ownership. And trusts can use the traditional set of trust loss rules that they currently enjoy. The third-party debt test is continuing to be refined, and we expect even further refinements once the Senate Economics Committee have considered all our submissions. Now, the other key measure that took us by surprise earlier on was a proposed repeal of Section 2590. Now, that's a measure which essentially traditionally allowed debt deductions incurred in relation to deriving foreign exempt dividend income. So a basic example is if an Australian group borrowed to acquire a foreign group, those deductions were still allowable, subject to the thin capitalisation measures. Now, that proposal has now been deferred, subject to further consultation. But in the interim, the government has introduced those new integrity measures or debt creation measures in relation to debt-funded distributions or asset transfers. There's been some other minor technical and drafting errors that have been fixed up, but there is still a few more to go. We go to the next slide, just to illustrate how the fixed ratio test works. And there you can see it is quite a straightforward mechanical calculation compared to what we've currently been experienced with the safe harbour debt test. The starting position is essentially your notional taxable income and subject to certain add-backs, right? So you're adding back your net debt deductions and you're adding back your tax depreciation amount under what we call in our Australian parlance the Div 40 and Div 43 deductions. Now, importantly though, as mentioned earlier, in that tax EBITDA, you cannot recognise distributions from associate entities, either dividends from corporates or your share of trust income or partnership income, on the basis that policy-wise, that those earnings are recognised in that entity that's making the distributions. Now, the most areas of potential technical uncertainty going forward is as part of the new suite of measures, the concept of a debt deductions has been expanded. So it not only includes interest, but it also includes amounts in the nature of interest, and doesn't necessarily have to be incurred in relation to what is a debt interest as defined in our rules. So it's a much broader, expanded definition, which the government is saying is in line with the OECD proposals. Potential issues we are seeing, though, in the concept of a net debt deductions, that on the deduction side, although it's quite expansive, on the income side, given the net debt deduction is a net concept, there is some asymmetry there. So you may be in a position that although you're borrowing and incurring costs and on charging them potentially to another entity, you may not have a perfect neutral outcome. Now, what's important here, and as illustrated in the diagram there, what we currently don't have under our thin capitalisation rules is that if there is a denial, it's permanently denied. Under the fixed ratio test, if there is a denial, that excess denial can be carried forward for a future income year to the extent that there's sufficient fixed earnings in that year, or it's fixed earnings ratio in that year. And that can be carried forward for up to 15 years under the Australian measures, subject to the equivalence of what we have under the loss recoupment rules, right? So for corporates, our continuity of ownership tests and business continuity tests. Now, you do also effectively forfeit the ability to carry forward excess denials if you elect another method. So if you elect in year 2 or 3, for example, to use the third-party debt test method, then you do forfeit that excess amount. So use an example on the next slide to illustrate some of these aspects. Always handy to understand these in the context of an example. So here we have a simple example where we have two investors who provide equity of $25 million each to a joint venture company. That joint venture company has also borrowed externally of $50 million. So you see on that, deliberately we put essentially a 50% gearing ratio, which under our current rules, you wouldn't have any denial, because under our current rules, you have a 60% Australian asset base, you'd pass the safe harbour and you shouldn't have any denial. However, as we now switch into an earnings-based test, you can see that assuming we've got $6 million of income, and assuming we have interest expense of $2 and capital allowance deductions of $1, we get a tax EBITDA there of $6. Now, you apply the fixed earnings limit there of 30%, we get $1.80. Now, you compare that to your actual net debt deductions of $2, and we get this denial of 20 cents, which can be carried forward. And that generally works how it's kind of intended to in this situation where you've got the debt at the asset level or the operating entity level that is generating the income. Now, the challenges we are seeing under the current draft of the bill is if the debt is at a different level. And if we look at the next slide, an example what you do typically see in practice where the investors themselves obtain their own individual funding from a bank, and they use a combination of that and their own equity to fund the JV co. So you've got each investor borrowing $25 million each from the bank, the debt sitting there, and they inject $50 million each of equity into the JV co. Now, at that level, if you think about the JV co, it has no debt deductions. So in applying the rules, it has all capacity, but no deductions to deny. However, given in this example, given investor one and investor two, all of their income is dividends from an associate, that cannot be counted towards tax EBITDA. So it really doesn't have any capacity to shelter the interest deductions on its loan. And so its net debt deductions are completely denied in this example. And those are some of the challenges we're seeing under the new rules, where structurally we need to start thinking about ensuring the debt is at the right level. Now, if we go to the next slide, and moving on to some of the alternative tests, and which is done by way of election, right? So in an approved form, the relevant entities have to choose to use this alternative test. And the third-party debt test, although it's kind of drafted to be agnostic to industries, it's quite clear from comments made in the Parliament and by government, and the way the rules are drafted and designed to be focused on the property sector and the infrastructure sector, right? Given the criteria that's required, which we'll go through in a minute, we don't expect it to be quite difficult for corporates to access these rules in an ordinary sense, unless you have a certain special project financing type arrangement. So what the key criteria is, as mentioned, the entity has to elect to use the rules. The debt has to be issued by a third party, essentially, so not an associate entity. Importantly, recourse can only be to that entity's assets, and there can be no guarantee security or other forms of credit support. Now, that's very, very restrictive at the moment, as the rules are currently drafted. There have been submissions made to at least ensure that guarantee or support made by what we're calling the obliger group can be counted for these to be workable and what we typically see in practice. Another key criteria is that the entity uses all or substantially all the proceeds to fund its Australian operations, right? So to the extent some, more than a certain extent is used to fund foreign operations, the entire test is failed. and you will not be able to rely on the third-party debt test requirement. Now, as part of these rules, because to take into account that typically conduit entities are used, finance companies are used, the rules do contemplate that external third-party debt tests can work through financing entities, notwithstanding that the borrower is borrowing from an associate. If we go to the next slide, and we talk about some of the implications we are seeing as part of the third-party debt test. Now, when that entity or the borrower makes a choice, the rules require that all of the entities in the obliger group, so any entities who are providing support, credit support, essentially under the third-party debt, are also deemed to have made that choice. So essentially, they are precluded from using the default tests. And so there's a number of problems there where, for example, you could have an associate entity that's where the threshold's actually quite low under this. It could be, might only have a 20% interest, who are now essentially forced to also use the third-party debt test more generally. And may have other issues or other projects that may be caught up with being able to satisfy the rules. A further implication is that obliger might be part of a broader tax consolidator group, and it's unclear whether then the broader tax consolidator group is now also forced to use the third-party debt test. So there are still a number of things to be worked through. A number of submissions have been made as part of the Senate committee inquiry, and we just need to wait to see how these rules fall into place. But the message is you have to be quite mindful of, if you did want to rely on these tests, that the arrangements with the third-party bank, who's involved as part of the obliger group, what assets are secured, who is providing security, all need to be carefully worked through. Because even if there's one of those criteria are met, it is a complete failure of the test. There's no proportionate element in terms of how the denial works. If we go to the next test, talk about the other alternatives here in the next slide. Is the group ratio test, something that has been recommended by the OECD, something we probably won't commonly see in practice. Essentially, if you can show that on a global basis, your earnings limit compared to your interest deductions is greater than 30%, then the Australian group can essentially rely on that ratio and apply that to its net debt deductions. The test is based essentially from audited financial statement-based information, but they are subject to certain adjustments and amendments, which do need some additional scrutiny of what's inside those financial information. For example, what things are that are considered interest or in the nature of interest, where certain entities have negative EBITDA, they need to be excluded. So there is a fair degree of additional work required to be able to satisfy this test. And for that reason, we typically won't expect a lot of groups will be relying on this test. Then move on to some other significant measures in the next slide, which is what is called essentially the debt creation rules. And there are two types of debt creation rules that have been introduced. One is this asset transfer rule, and the other one is essentially a distribution rule or a payment rule. So this one, the asset transfer rule, is essentially where the group borrows from any source, either from an associate or a third party, to acquire an asset from an associated entity. Right, so essentially, it's a leverage reorganization, for example, which we will typically see in, say, in an M&A transaction, where post-acquisition groups will want to bring, say, the Australian assets together. The existing Australian group might be funded to do that with a mix of debt and equity to acquire the Australian section of the broader acquisition. What these rules do is they actually will then deny a deduction for any debt that was incurred to undertake that transaction. So that is what it's intended to capture, but the rules are broadly drafted. It does apply to all CGT assets, legal and equitable rights, and could potentially even apply to the acquisition of any assets, including inventory. Now, a critical issue here, though, as the rules are currently drafted, it could still apply to historic arrangements. So to the extent you did some kind of reorganisation historically, and that debt is still in place, and you continue to enjoy interest deductions from 1 July this year, the rules could potentially apply to deny those deductions. Now, submissions have been made to ensure that there's some grandfathering to not capture those historic transactions, but that's a wait and see at this moment. Now, if we move to the next slide and talk about the other debt creation rule, this is essentially very simply known as, say, the leverage dividend rule or the leverage distribution rule, where you borrowed from an associate entity to make a payment to an associate. Now, although it's designed to be attacking distributions, the rules are drafted quite broadly and apply to any payment. So it could be any payments made to an associate entity that's funded by an associate. And even so far as broadly applying to even things like the acquisition of goods or even refinancing, the repayment of debt. So to the extent you have a shareholder loan currently, if you were to borrow, refinance that by virtue of a new loan and make that repayment, as currently drafted, the rules could apply to deny deductions on the new loan that's subject to the refinancing. So quite a broad, far-reaching set of rules. Now, on the next few slides, we've got a few observations there, what kind of typical practical observations are. In the interest of time, I'll just pick out a few things there rather than go through it. You will have access to the slides later on. What we're currently obviously seeing groups doing now is modelling their forecast EBITDA. And so the challenge of ensuring you have appropriate forecast information, how to best undertake those calculations, either from a top-down approach or a bottom-up approach, ensuring you have kind of reliable forecast information to make those temporary and permanent difference adjustments. If we go to the next slide, let's pick out another couple from the next slide. One thing that item 4 is something that groups are now going to be starting to grapple with is this now broader application of transfer pricing, where potentially you may currently have an existing loan that have been priced very conservatively, so what we're calling the green loan rating that the ATO has put out, where you may have quite a very conservative rate of interest on that loan. And if you have such a loan, what does that mean and what the appropriate amount of arm's length debt would be in the system? So notwithstanding that we no longer have a safe harbour debt amount, the question of now, what is an appropriate capital structure, will actually need to be thought through and applied before we even start thinking about the interest limitation rules. And so transfer pricing now does have a greater role to play in terms of a group's appropriate capital structure. Go to the next slide. And a few observations on the debt creation rules. As mentioned, the key thing to consider is if you have any historic transactions whereby debt has been introduced to do a reorganisation or a payment to a related party, whether the new rules could come into the scope of that. And even going forward, you might need to consider any kind of business of usual transactions that may be collateral damage as part of that. So there may be this requirement to really understand whether your debt funding used can be traced or not traced to some of those payments or distributions that the rules come within the scope of. So going forward, any refinancing of existing shareholder loans, post-merger reorganisations are something that needs to be thought through quite carefully. So on that note, that's the debt creation rules as part of the package of interest limitation rules. I might now transfer it to Amelia to take us through the proposals around the intangible asset measures.
Thank you, Manu. Changing tack a little bit, but still in this theme of denied deductions. As some of you may be aware, the Australian government announced earlier in the year that it would introduce this integrity measure to deny deductions in respect of intangibles payments that are made to offshore entities. Now, when the original consultation was released, there were a number of questions posed as to the scope of the law. It canvassed, comparisons to rules in other jurisdictions and really seemed to be quite broad. The context in which it would operate was not well articulated in the first consultation, and we've since seen 2 exposure drafts of the legislation that have started to take shape and really trying to explain what this new measure is about. But as we're here today, as Manu said, this is still in an exposure draft form. This particular measure has not yet been introduced as a bill to Parliament, although it has a proposed start date of 1 July 2023. This one was a proposal that is based on payments that are made, so it doesn't have an income year start date, it has a payment start date. And so we do have businesses in Australia, obviously, which are currently considering this proposal and the potential impact, despite the fact that we do not have actual legislation in play. So what is this rule about? As you can see on this slide here in the diagram, we've depicted kind of a simplified example of one of the things or one of the arrangements that could potentially be in scope of this rule. As I said, it's an integrity measure, or it's meant to be an integrity measure for payments in relation to intangibles. If the rule applies, there is a couple of different thresholds to answer that question. But if the rule does apply, then the result or the operative effect of this measure is that there is a denial of the deduction for the payment or part of the payment, which is a permanent denial from an Australian tax perspective. So the typical example or arrangement that we've depicted here kind of tries to explain what is potentially within scope. This is certainly the most likely conception of the rule, but it doesn't necessarily need to be limited to an inbound or foreign-owned Australian taxpayer, as we've depicted here. It's also possible that this rule could apply to payments made to subsidiaries of Australian companies as well. So there is a number of different conceptions, I guess, of the policy. So essentially, the payment that is potentially subject to this rule is that payment that's depicted here as being made from OzCo to the recipient, an offshore entity. And the tests are that the payment needs to be, or there is a denial of a deduction for that payment to the extent that the payment is attributable to a right to exploit an intangible asset. So we've highlighted the key parts to this measure there on the right-hand side of the slide. The payment needs to be made to an associate, either directly or indirectly. And so you can see here in this diagram that we have a payment to a recipient. That payment or that recipient then on-pays or has made a payment which can be arguably related to the payment received from the OzCo in this structure. And that payment is made to another associate entity within the group who is an owner of intangible assets, an IP owner. So here, I guess what we're depicting is that there is an indirect payment through to an associate in relation to that intangible. The associate eventual kind of recipient, I guess, of that payment needs to be deriving income from the exploitation of an intangible asset, and it needs to be related to an intangible asset located in a low corporate tax jurisdiction. And so those are really the key kind of components or the key elements to this test. It's introducing a number of those key components which are quite new: exploitation, intangible asset, and low corporate tax jurisdiction. These are all hurdles, if you will, or tests that need to be met in order for the rule to be triggered. It also applies if the Australian company acquires the intangible asset or the right to exploit the intangible asset. So I'll take you through a bit more of the detail on the next slide, but essentially you can see this is an extremely broad rule. So again, they're the kind of the building blocks or the threshold tests that are set out here. And so just to pull out some of the detail on a number of those tests or a number of those elements. So firstly, we look at what does exploit mean? So a lot of these terms and concepts have not been contained in the Australian tax legislation before. In one sense, we have seen over recent years the ATO lines of inquiry have been increasing in relation to intangible space and attempting to define through a number of pieces of guidance what an intangible is, what a payment in relation to intangible is, and how to effectively kind of tax those sorts of things in an ever digitalised world. We've had draft guidance on the characterisation of payments, for example. We've had a draft practical compliance guideline, which has been out for some time. And all of these pieces of guidance are really circulating or centralising around this concept of something which is intangible, is potentially movable, and how do multinational groups potentially achieve outcomes which are maybe not in line with expectation from a fiscal policy point of view. So this is the first time really that the Australian legislation is starting to codify this, and I guess it kind of creates quite a large amount of uncertainty in a sense, because the way that these terms have been defined is extremely broad. So as you can see there, the definition of exploit means or includes the use of a tangible asset, an intangible asset. It includes the right to market, sell, license, or distribute an intangible asset. It includes a supply or receipt of an intangible asset as a royalty, so something which is already dealt with within our domestic legislation, is subject to withholding tax, and is certainly a royalty as considered per many of our treaties. So those types of payments, which would be traditionally considered a royalty or already characterised as a royalty, are within scope of the meaning of exploit here. And it includes anything else. So the legislation, the draft exposure draft legislation does actually say it includes anything else in respect of an intangible asset. So I'm not sure that you could get much broader than that in terms of the meaning of exploitation. Importantly, it does include potentially payments for goods and services. This is the so-called embedded royalties issue. So if there is a payment which is notably for a good, for example, if there is an element or a part of that payment which includes an amount which is attributable to the right to exploit an intangible asset within that overall payment for the goods, that component of the payment could potentially be subject to these rules and in part denied under this measure. The examples of intangible assets that are contained in this legislation or this exposure draft include, the broad definition of intellectual property, but there is a couple that are called out specifically. Those are information or data, including the customer databases, algorithms, and there are some examples in the EM that are kind of alluding to the fact that these are the types of, I guess, industries or digital models and distribution models that might be arising in respect of those industries. Those are clearly intended to be within scope of this measure. So as you can see, very, very broad. Somewhat helpfully, this is only half the question. So if we flip on to the next slide, we'll kind of talk a little bit about the second half of the question. So this is intended to be an integrity measure, as I said, in relation to payments made in respect of intangible assets. What is necessary is to look at the counterparty jurisdiction and who is receiving that payment on the other side, either directly or indirectly. So the recipient back in our example, or the IP owner back in the example on the first slide that I discussed. So the key component here is that the payment needs to be received by an entity that is located in a low corporate tax jurisdiction. So the original consultation asked a number of questions around how this should be framed in terms of the mischief. Obviously, in light of the pending Pillar 2 legislation, there's been quite a lot of conversation and debate about how these two rules would fit together and lock into place, given that we have a global minimum tax that is pending in the 2024 income year. This rule sort of sits almost as a bit of a queue jump in relation to that rule if we have a trigger date of 1 July 2023. So what's been devised in the current exposure draft is more limited than what we saw originally, which is somewhat helpful. A foreign country is effectively a low corporate tax jurisdiction if it has a rate of corporate income tax, which is less than 15%. So that 15% obviously mirrors what we're experiencing with Pillar 2. Or the country has a preferential patent box regime. And in order to fall into that second component, that also requires an additional determination that something has a preferential patent box regime. So as yet, we're not aware of any particular countries that would be expected to fall within the scope of that rule. I say helpfully, this exposure draft has been more limited because as originally drafted, it was possible that almost every country in the world would be framed as a low corporate tax jurisdiction. But now what's quite clear is that in order to determine whether a country has a rate of corporate income tax which is less than 15, then you have regard only to the rate of tax which applies to income derived in the ordinary course of carrying on business. So it's really saying what is the headline tax rate in that jurisdiction. You disregard the effective deductions and offsets and other exemptions. You disregard progressive rates if they apply, or marginal rates, and you disregard, if there are different types of income. You have regard to the lowest rate. So really, what that's asking is that, in essence, for a payment of this nature to that particular jurisdiction, what is the ordinary headline tax rate? And so you don't need to look at the actual effective tax rate of the particular entity. You don't need to look at whether or not that actual entity or the country has offered a concession to that particular entity for the activity which is conducting. And that is somewhat helpful. So, to think about it from an Asia Pacific lens, often principal structures that are established in Singapore, there was a question as to whether they could potentially be within scope. I think this exposure draft helpfully clarifies that Singapore with a headline rate of greater than 17% would not be automatically considered a low corporate tax jurisdiction. Therefore, without this piece of the equation, even if you've done an analysis and there's potentially a payment which is for the right to exploit an intangible asset, that second piece of the scoping question, if it's made to a low corporate tax jurisdiction, we would expect would not be satisfied. If we just flip on to the next slide, I guess we'll just talk very briefly just through the examples that is contained in the EM, because it really adds the colour to what I guess the policy is trying to achieve or trying to target when it comes to this integrity measure. The issue that I think we have is that the way that it's drafted to capture this type of arrangement, which is the focus of the policy, is unfortunately still quite broad and does sit quite jarringly with the concept of us having Pillar 2 rules coming into play from 1 January 2024. This is an example taken directly from the explanatory memorandum, and it deals with that payment for goods or services. As I was speaking before, this is a potential rule that could apply where there is this embedded royalty, so to speak, where there is a payment for management services from Ozco here to Whiteco. If there is a relationship or a payment back to an enterprise or an entity within the group where there is an exploitation of an intangible asset at the headco level, then there is a question as to how much of that payment or the extent to which that payment is attributable to the right to exploit the trademark. And so certainly an overlap and an adjunct with the transfer pricing methodologies. I think many groups, many of our clients from an Australian perspective are really scratching their heads about how you would come up with a model to determine how much of that payment is in fact potentially attributable to the intangible asset, and therefore how much of the payment is potentially subject to this denial of deduction. With a start date of 1 July, as I said, we're heading into definitely a period of uncertainty. There are a number of other measures that are contained in the exposure draft, which I guess present a savings clause. So if Whiteco, for example, is situated in a country that is otherwise considered to be a low corporate tax jurisdiction, so it has a headline rate of less than 15, there have been some saving clauses added to the exposure draft, which allow us to take things into account. We assume things like domestic minimum taxes and the like as we roll forward into Pillar 2, but those things also unfortunately remain TBC, as we await some further consultation also in relation to Pillar 2. I think with that, just in the interest of time, Manu, I'll hand back to you maybe to just speak to some of the transparency measures. Oh, no, sorry, I have one more slide. Barry, one more slide further on just to cover off on some of those outstanding issues. I think I probably have just mentioned what they are. Withholding taxes is probably one I didn't quite pick up on. So withholding taxes, because this measure does also apply to things which are already characterised as royalties, there is a mechanism to take those into account. Unfortunately, it doesn't necessarily protect all the way. So if you do have a payment to a low corporate tax jurisdiction and it is subject to withholding tax, it does look like at the moment anyway, you can be needing to do some complex computations. Thanks, Manu. I'll hand back to you for the transparency section.
No worries. Thanks, Amelia. We do have a couple of questions which we have time we'll get back to. One question, if we go to the next slide, that was asked, is this the status of the bill and what the bill was? So the full title of the bill is the Treasury Laws Amendment Making Multinationals Pay Their Fair Share, Integrity Transparency Bill 2023. So that is currently before Parliament, which has the interest limitation rules in there and the first stage of the transparency measures. That was introduced into Parliament late June. As soon as it was introduced to Parliament, was submitted to the Senate Committee for considerations, and a number of submissions were made as part of that. Now, in the meantime, there is the formal process of passage through Parliament. It's currently sitting with the Senate at the moment. And so we would expect amendments coming out of that Senate committee to find its way into the bill. So on transparency, there's a couple of transparency measures being proposed. As I said, one is the first stage that's currently within the bill. And really the impetus behind all of this, as the government puts to us, is that although there is a current series of voluntary transparency measures in Australia, given what they perceive to be a low uptake, some inconsistency and unreliability of some of that transparency, the government is pushing forward with some codified measures and making them compulsory. Now, as we see, we already have some of those similar mandatory regimes in other parts of the world, in the EU and the UK, and we're seeing Australia becoming aligned to that. If we go to the next slide. Now, the measure that is currently before Parliament and to be live for the current income years, beginning on or after 1 July 2023, is essentially via the Corporations Law, where entities which are public companies which are already required to report under the Corporations Law, so any public company either listed or unlisted within that framework, as part of their consolidated entity disclosure statement, they must now also include further details about their subsidiaries, including their name, the status, either corporation, partnership, or trust, their place of incorporation and the percentage ownership of share capital held in there, and importantly, their tax residency. So quite a fair bit of detail around subsidiaries held within the consolidated group. The directors have to declare that information is true and correct, and all those declarations, disclosures made in the annual report, obviously subject to the existing audit framework, which obviously will need to be meet those standards. So some additional reporting requirement, quite similar to what some of you might be familiar with in the UK. And what we're finding from those experiences is that given perception rather than reality is the key here, to the extent you have some legacy entities in certain jurisdictions, certain flow-through or transparent entities, residents in entities that were part of historic structures and potentially pre-BEP structures, there is a process of going through of ensuring that they're cleaned up to ensure that the perceptions to the public are appropriate. If we go to the next slide, just want to touch on the proposal for public country-by-country reporting, which the government is committing to. We did have initial exposure draft legislation, which was quite broad and far-reaching. well beyond what we had seen in other jurisdictions. So to the extent that any global group had a subsidiary or a PE in Australia, they were required to publish their country-by-country reporting data. And at a quite a granular level in terms of various things. And those data requirements traditionally had things that went over and beyond the traditional country-by-country reporting that most of you are familiar with, and well over and beyond what's currently required under the EU regime. Now, as a result of several submissions made on that point, thankfully, two things have happened. Although originally slated to apply for income years commencing 1 July this year, that has now been pushed to 1 July 2024. So we have some more time to ensure the measures are appropriate and also aligned with the EU. So to the extent groups are already undertaking the work to be ready for the EU, potentially there should be some overlap there with the Australian requirement. The hope is there is some alignment. There was some at the original proposals, quite detailed requirements around disclosing related party expenses, effective tax rates and explanations, and an interest around intangible assets in terms of what they are and their value. And as you can see from Amelia's section, there is this keen interest on intangibles. Thankfully, the government is moving away from that, given public consultation of potential disclosure of commercially sensitive information, and also an additional compliance burden over and above what we see in other parts of the world. So there is further work to do on this, particularly around what the level of disaggregation may be in terms of these disclosures. We go to the next slide. As you can see, what we're seeing is this now renewed a real focus on transparency, and what we're seeing groups focusing on as part of their broader ESG approach. This is essentially the G part of the ESG, the governance and tax governance part of it. Data is going to be quite important here, and the overlaps of the various reporting measures. Your let's call it your confidential CBC reporting, public CBC reporting, EU reporting, and as Amelia will now kind of touch on soon, the additional data points that we'll need to be compliant with Pillar 2. Again, a real optical scrutiny on the group structures and what perceptions they might give, and the opportunities to potentially clean up some of those legacy structures. Things like partnerships, low tax jurisdictions, to the extent there are entities there, there's some thought to be put around whether they still should be there. And the other key thing that the government has announced, that although initially planning to legislate, but now said they'll go through an administrative process, is that any tendering for government work, there has to be a disclosure around the tax residency and tax aspects of the tenderer. So a number of things to be kept in mind in terms of transparency going forward. On that note, and that kind of segue to data and getting things together, the introduction of Pillar 2 and the status of that, Amelia, if you could enlighten us.
Thank you. All right, if we can just go to the next slide. I think just before we do, I think there was a question in relation to the intangibles measure and whether the US FDII regime would impact that 15% rate. I think given the changes that have been made to the latest exposure draft, that question has been cleared up that's not relevant. So we wouldn't take into account the concessions in working out whether the US is a low corporate tax jurisdiction. So therefore, we would just look at the headline rate of 21%. And so our expectation is that the US would not be a low corporate tax jurisdiction for the purposes of that intangibles measure. But leading into Pillar 2 and what is kind of considered low tax, obviously globally the OECD has and all of the inclusive framework members of the OECD have agreed that the 15% minimum tax is what needs to be set as we head into this new world of Pillar 2 taxation around the globe. So just as a kind of a recap of what's happening around the world, it almost seems that we've got changes every day, but legislation from a domestic angle is starting to come to the fold. Obviously, we've had OECD model rules since 2021, and that requires domestic law change to become effective so that the framework can be properly implemented around the world. I guess some of the interesting ones that are often noted globally and then from a regional perspective is that the US, due to its kind of political structure and some of the difficulties in terms of, whether the measures really have the support of the two sides. It's clear that the Republican Party does not support the Pillar 2 regime, whereas the Democratic Party does. And so we see difficulties in ever really that coming to light within the time frame that the OECD has set. So from a US perspective, I think we would typically say, no, there is no Pillar 2 regime, at least in the near term. Interestingly, from a regional perspective, I understand that China nor India have committed to a time frame, though of course they are included as part of the OECD's inclusive framework and have committed to the common approach. We're yet to see a movement from those countries. And I guess what's interesting is that South Korea was actually the first country that did in fact implement and enact Pillar 2 legislation. We've now had confirmation that the UTPR will be delayed by 1 year, and so it will have a start date of 2025. But South Korea does have a start date of 1 January 2024 with enacted legislation. The UK, of course, has enacted legislation. EU member states also have a directive which requires those states to implement their laws in time for a 1 January 2024 start date. And I think many of those countries have draft or pending legislation, which is soon to be introduced. Of course, Australia likes to follow suit with these things. So we've also announced that we'll have the legislation for income years based on or after 1 January 2024. However, as Manu said earlier, we're yet to see our draft legislation. I think just to complete the picture from a regional perspective, Singapore has made an early announcement that it would implement an income inclusion rule as well as a QDMTT or qualified domestic minimum tax, however, no earlier than 2025. So there's clearly an element of wait and see what the rest of the world does before it's making a move. I guess what that means is that we might see some instances where there is a bit of a shuffle between the tax liability from a Pillar 2 perspective between countries as countries start to come online at slightly different points in time. But clearly over the next few years, we'll have this regime fully in place. If we just flip on to the next slide, I'll just do a quick recap in the interest of time. I'll just do a really quick recap as we've probably already alluded to what's happening from an Australian perspective. There was, Australia has been quite active in terms of its consultation and its working group matters in relation to Pillar 2 and being, quite a keen participant in the OECD process as these rules have developed and as the guidance continues to be developed and released. However, from a domestic point of view, you've seen, through the session today, you've seen the number of multinational measures which are on the agenda from a legislative point of view. And I think that, unfortunately, Pillar 2 just hasn't yet been able to get any airtime or hasn't been able to get some resources to focus on. So it could be the case that despite the fact of us having a 1 January 2024 start date, we'll only see draft legislation towards the end of this year. We may not have a fully enacted bill when the rules actually become operational. I guess one positive, despite that, is that the expectation is that Australia will closely follow the OECD model rules, if not do a complete a lift of those. It's yet to be seen how we actually implement, but we're certainly not expecting any departures from the OECD model rules. Of course, what's interesting is that despite us having a 30% income tax rate, Australia has announced that we'll also have a domestic minimum tax and hopefully a qualified domestic minimum top-up tax. That fits in, I guess, with some of the OECD guidance that we've started to see more recently around safe harbours and the like. And certainly the strong expectation is that our qualified domestic minimum top-up tax would be aligned or completely aligned with the Pillar 2 framework. Of course, just to note a few, compliance obligations. Manu spoke a little bit about the data. That is really what's driving a number of conversations from an Australian perspective. How do you prove that your effective tax rate is above 15 and therefore that there is no Pillar 2 top-up tax or exposure? We've seen now that the OECD has Globe Information Return, which is somewhat final. And maybe if we just flip on to the next slide, I'll just summarise what some of those OECD amendments are and how the Australian view is expected to shape up. So just on the next slide, you'll see that there has been a number of pieces of guidance released from the OECD over time. The most recent guidance was released just last month, and it included the Globe Information Return, the final version of that return, as well as a number of items which were technical issues that were still outstanding from an OECD perspective, and the guidance has been introduced to cover off on some of those. Importantly, I'll just note the safe harbours there. On the Globe Information Return, Australia has indicated that it would also have a kind of a local, filing expectation if you are subject to top-up tax or for the domestic minimum top-up tax. Our keen observation or our keen views that are put forward is that should closely align with the Globe Information Return. I'm conscious that we have hit time, so I think if we have questions left over, we'll take those offline and we'll respond to them. But thank you very much for joining us today for this debrief.
Thank you, Amelia, and thanks to all of you who were able to join us. We encouraged you to do fill out the short survey that will pop up on your screen momentarily and tell us what you think about today's program. If you joined us late, please note that this presentation will be archived for future viewing. If you feel that others would benefit from this webcast, please share the webcast via the share this icon or have them visit the Dbriefs website. We'll respond to all the questions, as Amelia said, submitted during the webcast in a couple of weeks. So thank you for those questions. We will respond to those. Also, if you think of any other questions or comments later, please feel free to reach out to me or Amelia. We'll be happy to talk to you. Last, from all of us at Deloitte, thank you for participation in today's Deloitte Asia Pacific Tax webcast today. Goodbye.